Okay. So last week we started with project-specific cost of capital, and we said that the project-specific cost of capital is computed when a company is diversifying or when systematic business and financial risk of a company are expected to change as a result of undertaking a project. When a company is moving from one industry to another industry, the existing work of the company will not be suitable to appraise projects in the new industry. Therefore, a cost of capital that will be consistent with the risk associated with the project will need to be estimated. And this is what we call project-specific cost of capital. So we discuss some terminologies, including business risk, financial risk, proxy company, as well as asset beta, and then equity beta. Not only that, I also provided you, I demonstrated the procedures that you need to carry out anytime you want to calculate project-specific cost of capital, which include step 1, you are expected to identify the proxy beta. And I said that to identify the proxy beta, just go to the section of the question where you have information on the of the proxy company. So from there, you are going to see, examiner will surely give it to you, the proxy beta. Then step 2 is to ungear the beta if it is geared. The beta in step 1 will be geared if the proxy company has debt in its capital structure. If the proxy company has a form of debt like bond, okay, debenture, loan note, or bank loan, in this case, it means that the beta of the proxy is a gear beta, which means you need to ungear it. And I said that to ungear, simply go ahead and calculate asset beta, because asset beta measures only business risk. You want to determine the beta that will measure the industry that the company is moving to. Okay. Not only that, I also provided you with 2 different formulas that you can use to ungear, depending on whether debt beta is given or debt beta is assumed to be risk-free. All right. Then we'll move to step 3, which is to regear, to incorporate the financial risk of the main company. All right. Again, I provided you with 2 different formulas that you can use, depending on whether the debt beta is given or is assumed to be risk-free. And I said that for step 1 and step 2, you need the information of the proxy company, information that relates to equity value, debt value, tax rates, as well as a debt beta of the proxy. Then from step 3 up to step 5, you need the information of the main company in relation to equity value, debt value, tax rate, and then debt beta. Now, we move to step 4. We say step 4 is to compute cost of equity using capital asset pricing model. In step 4, you calculate cost of equity using capital asset pricing model. And then step 5, which is the final step, is to calculate project-specific work. The same formula you normally use to calculate weighted average cost of capital. All right, so it's pretty straightforward. And then it's very common in ICAN, particularly in recent time. The examiner is in the habit of combining cost of capital with NPV. All right, so examiner will just give you scenario. It could be, in most cases, it will come as a compulsory question. All right, so a scenario will be painted, and then examiner can ask you, required A, calculate appropriate cost of capital. Then B, evaluate the project and advise. Once you are asked to calculate cost of capital, like I mentioned in our previous classes, you need to go to the question and determine what kind of cost of capital you need to calculate. Is it traditional work? Is it project-specific work? Is it WACOCA, work of the combined activities? So whatever they want, whichever one that you want to calculate, the information will surely be there in the question. And like specifically, I mentioned that this project-specific work is calculated when a company is diversifying. So that is the only key. That is the unique feature. All right. That's what will give you a hint that this is what you need to do. All right. So if that is the case, I think we need to move on. I've already explained all the concepts that you need to know as far as project-specific cost of capital is concerned, because today we have to complete cost of capital. Today will be the lecture day 6 on cost of capital. And by next week, when we are going to meet, by the grace of God, it will be a different topic that we are going to be discussing. All right. So let's have illustration. After this, then we'll move to WACOCA. All right. So my plan is to complete our cost of capital today. So let's have illustration. Yes, I need one of you to read illustration number 20, Kilimanjaro PLC. Who is helping us to read it?
Kilimanjaro PLC.
Thank you. Go ahead.
Kilimanjaro PLC produces domestic electric heaters. The company is considering diversifying into the production of freezers. Data on 4 listed companies in the freezer industry and for Kilimanjaro are shown below. All figures assumed correct. The par value per ordinary share is 25 kobo for Mississippi and Zambezi, 50 kobo for Nile, and 1 naira for Limpopo and Kilimanjaro. Corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the Treasury bill rate, which is currently 9% per year. Treasury bill rate, which is currently 9% per year. Corporate taxes are payable at the rate of 35%. The market return is estimated to be 16% per year. Kilimanjaro does not expect its gearing to change significantly if the company diversifies into the production of freezers. You are required to 1. Estimate what discount rates Kilimanjaro should use in the appraisal of its proposed diversification into freezer production. 2. Corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption and calculate how important this assumption is likely to be to Kilimanjaro's estimate of a discount rate in A above. For this purpose, assume that Kilimanjaro and the 4 freezer companies all have a debt better that's in share of 0.3. Discuss whether systematic risk is the only risk that Kilimanjaro's shareholders should be concerned with.
Thank you very much, Sarah. So
is it that for this thing they are always diversifying?
Pardon?
Are they always diversifying into a different business?
Who is diversifying?
They want to diversify into freezer production.
No. It's the scenario of the question, and examiner is just, I mentioned to you that to calculate project specific, the only indication is that once you can seal in the question that the company is diversifying, that means you need to calculate project specific. It's not that they are always diversifying. So it's the nature, is the scenario of the question. All right.
Okay,
the question will tell you what you need to do.
Yeah. Okay. Thank you.
All right. So in the first requirement, you are to estimate what discount rate Kilimanjaro PLC should use in the appraisal of its proposed diversification into freezer production. Even from the first requirement, I can see diversification into freezer production. Not only that, when you go to the first paragraph of the question, examiner has told you that the company is considering diversifying into the production of freezers. So which shows that this question relates to project specific. All right. So we want to calculate project specific cost of capital. So what I need to do, the first step is to identify the proxy beta. I will ungear the beta if it is geared. I will re-gear. I will calculate cost of equity using capping. Then I will calculate project-specific WACC. It's as straightforward as that, all right? However, in this particular question, the name of the main company is Kilimanjaro PLC, and we are given 4 different companies in addition to Kilimanjaro. These 4 freezer producers, they are the proxy companies. Like I said, once you are given a scenario and the name of the main company is mentioned, any other name you see in the question will represent the proxy company. And at times, examiner may not mention the name of the proxy company, but there will be indication in the question that will show you that they are referring to proxy company. All right. So if that is the case, let me stop sharing this and move to the working notes. Okay. Solution to illustration number 20. That is page 34. All right. So the name of the company is Kilimanjaro. All right. Requirement number 1. Calculating projects specific cost of capital. Why are we calculating project-specific cost of capital? Because examiner has told you that Kilimanjaro is diversifying into production of freezers. So if that is the case, you are expected to calculate project-specific cost of capital that will be consistent with the risk associated with the freezer industry. All right? Good. Then step 1. Step 1 says we should identify the proxy beta. Now, in your own case, there is no need for you to say identify proxy beta. Just go ahead, just indicate your proxy beta. All right, I will say proxy beta. In this question, we have 4 different proxy freezer companies. We have 4 freezer companies. So in that case, you need to find, because you need only 1 beta. You have been given 4 different betas, so you need to add all of them together, divided by 4 to have the average. So I would then say beta, let me rewrite this. Okay. So we are going to add up the beta of Mississippi plus the beta of Limpopo plus beta of Zambezi, then plus beta of Nile. We divide it by 4. That will give us average beta. But in most cases, it will be only 1 proxy company. This is just a special or unique question. All right. So equal. I will then go back to the question. All right. What's the beta of Mississippi? Give it to me.
1.10.
1.1 plus beta of Limpopo
1.25.
plus beta of Zambezi
1.3.
and then beta of Nile
1.05.
1.05. So I will add up everything and divide it by 4. That will give me the average. So give it to me. What do you have there? 1.1.
75.
Pardon? 1.17.
1.175.
Okay, so because the beta given to us are in 2 decimal place, so we round our number to 2 decimal place, 1.18. So the beta of the proxy beta is 1.18. So we are done with step 1. We then move to step 2. Step 2 says you should ungear the beta if it is geared. You will only consider this step 2 if the beta in step 1 is geared. And I said that the beta will be geared if the proxy company has debt in its capital structure. When you go back to this question, you can see bank loan for the proxy companies. So it means that the beta of 1.18 is geared. So if it is geared, then we need to ungear it. Okay, ungear to remove the financial risk of the proxy companies. So in this case, the formula you are going to use to ungear will depend on whether debt beta is given or debt beta is assumed to be risk-free. So according to the question, are you given debt beta? Please, I need you to participate. Go to the question. Are you given debt beta or debt beta is assumed to be risk-free?
Is almost risk-free. So it means we are given.
No, examiner say
Almost
corporate debt.
risk-free. It's risk-free. They said risk-free.
Okay, debt beta is not given. All right. The bottom line is that debt beta is not given in the question. So if debt beta is not given, then I will then say asset beta. So on gear, you are supposed to calculate asset beta. Therefore, asset beta is calculated as beta equity of a gear multiplied by equity value divided by equity plus debt, 1 minus tax of the proxy company. All right. If I like, I can say or beta equity of a gear multiplied by 1 divided by 1 plus 1 minus tax, debt equity multiplied by debt equity proportion of the proxy. Whichever of the two formulas I use, I will get the same answer. All right. Anyone that is more convenient for you is what you should use. Therefore, beta assets will then be equal to the beta equity of a gear company is 1.18 multiplied by, I need equity value of the proxy company as well as the debt value of the proxy company. It's not given in the question, so you need to go and calculate it. Yes, Ufoma. Speak up,
Hello,
Ufoma.
sir. I'm seeing a 0.3 as debt. Hello, sir. Good evening, sir.
That's another requirement. That's another
Hello?
requirement. The 0.3 you have there is not is for the requirement number 2. Do you hear me, Ufoma? Okay.
Yes, sir.
All right. So we need to calculate equity value as well as the debt value of the proxy company. All right. So I will then go back to the question, how am I going to calculate equity and debt value? Of course, the same way you normally calculate equity and debt value under traditional work is the same thing. To get the equity value, you multiply number of shares with the share price. All right. To get the debt value, you multiply nominal value, you multiply with the market price of the debt. All right. So that will give you the market value of the debt. All right. So let's go back to the question and identify that. Let's say this page will be first and the second page will be for our calculation. Then the third page will be for workings. All right. Let's have workings here. So working number 1, we want to calculate market value. Okay. So equity value is equal to number of shares. In the question, are we given number of shares? I think we are given share capital. We are not given number of shares. When you look at the capital structure, ordinary share. So we are given share capital. All right. So I will then come here share capital divided by examiner has told you to use par value. Par value is the same thing as nominal value or face value. All right. So here will be divided by par value. I don't know why this pen is not writing well today. Par value multiplied by share price. Now, when you look at this question, share price is not given to us. We are not given share price. All right. Ordinarily, I'm supposed to multiply number of shares with the share price, but share price is not given. But examiner has given to us earnings per share as well as the price earning ratio. So that's what we are going to use to get the share price. You will recall in the statement of in the financial statement analysis, ratio, for example, when you want to calculate one of the investors' ratio is the price earning, All right. So to get the price earning ratio, usually you say price earning ratio equal to share price. What's wrong with this pen? Okay. Price earning ratio is equal to share price divided by earnings per share. All right. This is the formula for calculating price earning ratio. All right. So if price earning ratio is given to you, you're also given earnings per share. That means this is the formula that we can use to get the share price. So we just make share price the subject. So in this case, in this particular question, since we are not given the share price, I can then say share price is equal to price earning ratio I don't know what's wrong with this pen. It's not flowing well. Okay. So equal to price earning ratio multiplied by earnings per share. All right. So this is the formula according to the question. That's the formula we are going to use to calculate the share price. Therefore, you are going to calculate market value of equity for each of the 4 freezer companies. So for Mississippi, the share capital of Mississippi is 4,000 naira. Now then the nominal price, the par value of Mississippi is 25 kobo. So 4,000 divided by 45 kobo, 25 kobo rather. So here the share capital is 4,000 naira divided by nominal price, 25 kobo. Multiplied by the share price. I don't know the share price, so I need to go and work it out. Therefore, the price earning ratio of Mississippi is 12 times, is 12. Then earnings per share is 25 kobo. So 12 multiplied by 0.25. So 12 multiplied by 0.25 equal, that's 3 naira. Here is 3 naira. So 4,000 multiplied by 3 divided by 0.25. Okay, multiplied by 4,000 equal
8,000.
divided by 0.25. That's 48,000 naira. Figures in thousand. Here is 48,000. All right. So we are done with Mississippi. We then go to Limpopo. We go to Limpopo. Shinozo, please mute. So for Limpopo, the share capital of Limpopo is 9,000 naira. Then divided by the par value of Limpopo is 1 naira. 9,000 divided by 1 naira. Okay, then multiply by the share price. I don't know the share price. Let's work it out. The price earning ratio of Limpopo is 10. Then earnings per share is 53.3. 10 multiplied by 0.533. So this will give us 5 naira 33 kobo. 5 naira 33 kobo. 3, 3. Anyway, we manage it like that. I don't know why you are not writing word to not. Here is 9,000, not 7,000. So 9,000 multiplied by 5.33. That's 47,970. 47,970. Then we do for Zambezi. The share capital of Zambezi is equal to 3,500, and then the par value is 25 kobo for Zambezi. 35 divided by 0.25. 35 divided by 0.25.
That is 0.5.
Pardon?
It is 0.5.
Are you sure? For Zambezi,
Yes,
we are told that the par value per ordinary share is 25 kobo for Mississippi and Zambezi.
Okay.
It's 0.25. Hey, I don't know what's wrong with this pen. It's not flowing well. Anyway, 0.25. So multiply by the share price. I don't know the share price. Let's work it out. Price earning ratio of Zambezi is 9. 9 multiplied by 0.3810. 9 multiplied by 0.381. Okay. That's yes. 38 on 1 kobo.
3.429, sir.
3.429. Thank you. So let's multiply that with the rest. 3.429 multiplied by 3,500 divided by 0.25.
48,006 naira.
48,000 and then 6 naira. The last one for the proxy is 9. For 9, the share capital of 9 is 5,300. Then the par value of 9 is 50 kobo. 5,300 then 0.50 multiplied by share price. I don't know the share price. All right. So price earning ratio of 9 is 14. Earnings per share is 0.323. So 9 multiplied by 0.323.
5.
0.323. What do you have?
2.907.
2.907. 2.907. Okay.
It's not 9, it's
We
14.
are computing
Guys,
for
14.
Oh, it's
14, not
14, right?
9.
Oh, error of mind. Thank you.
4.522.
4.522. 4.522. Multiply by 10,600. Yeah.
47,933.
47,933.
33.
So we have calculated equity value for all the 4 freezer companies. So the next thing we need to do is to just add everything together. So let's add all of them together to get the total equity value. Add the 4 of them together. This is the total market value of equity for the proxy company.
Yeah.
Yes, Charity, you raise hand.
191,000.
Talk to me. 191.
Okay. 909.
909. 909. So that's the total market value of equity. So Charity, you raise hand. Okay, you even have your sir. I'm not seeing your writing clearly. What? Okay, I will try and improve on that. Okay. Sarat, go ahead.
Please, where did you get that 50 kobo for 9?
Is there?
I've been looking
Is
for
there in the
it. I didn't
questionnaire?
see it.
You are told that 50 kobo for 9.
Oh, in the body of the
Have you
question.
seen it?
No, but I'll look for it.
Was it not you that read the question?
It's not
All
me.
right. So we just calculated market value of equity for the 4 freezer companies. The next thing we want to do is to calculate market value of the debts. When you look at the balance sheet, the information given to you for the proxy company, you are given bank loan. Bank loan, you cannot have market value for bank loan because bank loan is a type of non-traded debt. You cannot buy loan, you can also not sell loan. So there's actually no market value for bank loan. Therefore, you add up all the bank loans for the 4 freezer companies together. So that will give you the total debt value. Okay. Yes, I will then come here. Bank loan. D, that's the debt value. So we are going to add up the bank loan of Mississippi plus that of Limpopo plus Zambezi plus Nile. All right. So here, D will be equal to, what's the first one? The bank loan is 5,300, then 12,6. 53 plus 12,6 plus
18,2.
18,2, and the last one,
4,000.
4,000. So let's add it up.
4,100.
40,100. All right, so that's the total debt value. All right, so in this case, I can go up there. You can see we abandoned the calculation since because we are looking for, the variables we are looking for was not available. So we have to go and do working for it. So now that we have it, let's proceed. Equity value of the proxy company is 191,000. 181,909. All right. Divided by 191,909. What's wrong with this? Oh, God, I pen. 191,909 plus the debt value of 4,100 multiplied by, what's the tax rate of the proxy company? What's the tax rate of the proxy company?
35%.
35%.
So 35% is given for both proxy and then the and Kilimanjaro. So 1 minus 35% will give us 0.65. All right. So that's that. So in this case, I would then say beta assets. What's the final answer? Beta asset equal to 0.65.
So I got 0.7 or not 0.65.
What do you mean by 0.7? Tax
Like
rate
the
is 30.
tax.
If tax rate is 30%, 100% minus 30 minus 30 minus 35%. Is it 70 will give you
0.65.
65?
Thank you.
Informer.
So I've gotten it. Thank you.
1 minus 0.65. Is it 70% or
65 is 65.
okay. So what's the final answer?
1.27.
1.27.
7.
It cannot be. Beta asset, this 1.18 is a gear beta. So asset beta cannot be more than gear beta. Do the calculation again. 0.65 multiplied by 4,100. Pardon?
1.04.
1.04. You are correct. 1.04. That's the answer. All right. So after this, we need to regear. Step 3. Regear. What's wrong with this? Is it because I changed the screen? This is not flowing well. Please mute. So we regret to incorporate the financial risk of Kilimanjaro. Because debt beta is assumed to be risk-free, therefore to regear, I would then say beta equity of a gear is equal to beta assets in step 2 multiplied by 1 plus 1 minus tax. Debt equity proportion of Kilimanjaro. Okay, that is the formula we are expected to use. So if that is the case, I would then say beta equity of a gear equal to 1.04. That's the beta asset we got in step 2. Multiplied by 1 minus 1 plus 1 minus tax. Tax rate is 35%, so that's 0.65. So examiner has given us the same tax rate for proxy and Kilimanjaro. Now, I need debt equity proportion, value of debt and value of equity of Kilimanjaro. So we need to go and work it out. So for Kilimanjaro, okay. This is not looking good at all. I don't know what's wrong. Kilimanjaro. So equity value of Kilimanjaro, the same way you calculated the equity value for the proxy. Okay, so the share capital of Kilimanjaro is 4,000 naira. Then par value of Kilimanjaro is 1 naira. 4,000 divided by 1 naira. Okay, multiply by share price. I don't know the share price. I need to work it out. Price earning ratio of Kilimanjaro is 8. Earnings per share is 106. So 8 multiplied by 1.06. 106 kobo is the same thing as 1.06. 106 kobo. Let me rewrite this one. Therefore, 8 multiplied by 1.06. 1.06. That's 8.48. So 8.48 multiplied by 4,000.
33,920.
That's 33,920. Okay. Then the debt value, the bank loan of Kilimanjaro. No. This thing is not flowing well today. Bank loan of Kilimanjaro, which is the debt value, is equal to what? 17,400. So let's add the two together. When we want to calculate WACC, we are going to need it. When you add these two, that will give us 51,320. That's the total value. That's the total value of Kilimanjaro. All right, so let's go up there. Some people send charts. Probably you need to restart to get the pen right. Okay. What are we calculating now? You're on your own. Informal, you ask me what are we calculating now? Eh? Equity value of the main company. Okay. Always, you can raise your hand and speak up so that you get immediate answer to your request or to your question. All right. Okay then. So 51320, let's go up there. Equity value of Kilimanjaro is 33920. Debt value is 17,400. Therefore, 17,400 divided by equity value 33920. Okay. So beta equity of a gear will then be equal to, okay. So this should be 17,400. 17,400 divided by 33920. 17,400 divided by 33920 equal, multiplied by 0.65 equal, plus 1 equal, multiplied by 1.04.
Sir, please scroll up a bit.
Why?
1.9.
1.39.
No,
I should leave the calculation and scroll up.
no, sir.
Right? So beta equity of a gear is 1.39. So why do you want me to scroll up when I'm still going to share the material with you? I should wait for you to copy, right? Hold on. Let me finish what I'm doing. After that, I will share with you, then you can form your notes to slow down the class. Now, we have calculated, we have regeared. The step 4 is to calculate cost of equity. So using capping, we want to calculate capital asset pricing model. All right. So capital asset pricing model, that is cost of equity equal to risk-free rate of return plus beta multiplied by market risk premium minus risk-free rate of return. So cost of equity equal to, I will go back to the question, what's the risk-free rate of return? Remember, the risk-free rate of return is the rate of return associated with government security. Government security include federal government bonds as well as a treasury bill. All right. So according to the question, examiner has told you that corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above the treasury bill rate, which is currently 9% per year. So the risk-free rate of return is 9%. So here will be 9 plus the beta of 1.39. Market return. According to the question, we are given market return to be 16%. All right. Market return is estimated to be 16% per year. So here is 16 minus 9. What's the cost of equity?
18.73.
Thank you. 18.73%. Like Alamide suggested, maybe after this question, I will restart my PC and see if there will be changes, because this is really slowing down my work. It's not flowing well at all. Okay. Now, finally, we need to calculate step 5. We calculate WACC, project-specific WACC. Okay, WACC. Therefore, WACC, weighted average cost of capital, because we have only equity and debt. So weighted average cost of capital is equity value divided by equity plus debt multiplied by cost of equity plus debt value, equity plus debt multiplied by after-tax cost of debt. KD. Hey. Oh, wow. 1 minus tax. This is not looking good at all. Okay.
Maybe you can start the working notes again. Maybe it would be better.
It's not even the working notes. It's I believe it's the screen and the pen. Earlier today, I used liquid to clean the screen. Maybe that's why it's misbehaving.
Okay.
I think that's because I use it. Yeah, I used it on Saturday and there was no issue like this. Okay. Yes, the WACC will then be equal to equity value of Kilimanjaro. We calculated 33,920. The total value of equity and debt 51,320 multiplied by cost of equity we just calculated, which is 18.73. 18.73% on one side plus the other side. The debt value is 17,400 multiplied by cost of debt. What's the cost of debt in the question? Examiner has told you that corporate debt may be assumed to be almost risk-free and is available to Kilimanjaro at 0.5% above threshold bill rates of 9%. So 5.5% above 9%. That will be 9 plus 0.5. That's 9.5%. Okay. So multiply by 9.5%. Then multiply by 1 minus tax. That's 0.65. Divided by the total value. Total value is 51320. Okay. So from the left, this should be 33920. 33920 divided by 51320 equal multiply by 18.6, 18.73. That's 12.38%. 12.38% plus the other side, 17.4 multiplied by 9.5 multiplied by 0.65 equal, then divided by 51,320. That's 2.09%. 2.09%. So when you add the two together, then we have 2.09 plus 12.38. That's 14.47. 14.47%. So approximately
14.47.
So approximately our work is 14%. The project specific work is approximately 14%. So this is how to calculate project specific cost of capital. This is how to calculate project specific cost of capital. So let me know, I think somebody sent a chart. Yes. Okay, charity. All right. So let me know if you have any concern on the calculation. So I want to spend 1 minute to restart the system and see if the flow will change for better.
So can you re-explain that step one again?
Step one. Okay.
Identifying the proxy beta.
Yes, I said step one, you are expected to identify proxy beta. And as far as this question is concerned, what are you supposed to do? Just go to the section of the question where you are given information of the proxy companies. So you can see from the question, from the table given to you, you are given beta equity for all the 4 freezer companies. So you need only 1 beta. And here you have, because you have 4 different companies, you have to add all the betas together, then you divide it by the number, we divide it by 4. And that's how we got the average beta of 1.18. Is it clear, Ima?
Oh, very clear, very clear. Thank you.
All right. You are welcome. Yes, Dami, go ahead.
Good evening, sir.
Good evening.
We don't calculate value of bank loan.
Pardon? Pardon? Dami, take your question again.
Sir, I said, can you explain the reason why we don't calculate the value of bank loan? Market value of bank loan.
Bank loan, there is no market value for bank loan. Bank loan is not tradable. It's not something you can buy or sell in the market. So it's not tradable. So if it is bank loan, just go to the balance sheet. Go and pick the value you have there. That's the book value. All right?
All right, sir. Thank you, sir.
You're welcome. Okay. So let's move to the second part of the question because of time. Number 2, Examiner is asking you, corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption and calculate how discount rate in A above. For this purpose, assume that Kilimanjaro and the four freezer companies all have a debt beta of 0.3. Now that examiner has given you debt beta of 0.3, it means that you need to recompute your cost of capital. Now, in this particular requirement too, there are two actions that you are going to perform. The first one is to explain if truly corporate debt is risk-free. Then two, you compute the project-specific WACC since you have been given a debt beta of 0.3. In the first requirement, debt beta is assumed to be risk-free. In this second part, you are given a debt beta of 0.3. Then you need to recompute it. All right then. So how do you answer the question? Examiner is asking you that corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption. All right. So is it true that corporate debt is risk-free? Let's answer that. Now, let me explain before we begin to talk about whether it is risk-free or whether it's a realistic assumption. When you talk about corporate debt, you can borrow loan, you can borrow through, you can issue bond as a company or as a borrower. You can issue bonds. All right. So is it certain that when you invest in bond, for example, you cannot lose your money? Is it true that when you borrow somebody loan, you cannot lose your money, you are going to get your money back? Is it certain? Is it true that corporate debt is risk-free? So that's what the examiner wants you to explain, whether it is true that if you invest money in bonds, if you invest money in any form of a debt, then of course that money is secured. Yes, I'm putting it to you. Is it true that when you invest in on debt, it is risk-free?
It is not true, sir.
It is not true. Why do you think so?
Every debt carries some element of risk.
Carry some element of risk. All right, you are right. However, let's put it in a perspective. Okay. Let me see if I can write it down. Let's see. Corporate debts. This is 2A. 2A. All right. So corporate debts. I hope this thing will not rag jaga jaga. So examiner is asking you that to explain if truly corporate debt is risk-free. So I would then say the assumption that corporate debt is risk-free is not realistic because then Roma figure 1 or number 1 because 1 when a company liquidates, okay, I've started again. When a company liquidates, when okay, let me go to the other line, whether it will change. When a company liquidates, okay, the assets are realized, that is disposed of. The assets are realized and the liability settled realized, and the liability settled. Therefore, any outstanding liability, therefore, any outstanding debts will be forfeited. Any outstanding debts not covered, okay? Any outstanding debt not covered by the proceeds I didn't foresee that I will experience this tonight. Any outstanding debts not covered by the proceeds. Let me even rewrite this covered. It's not clear at all. Not covered by the proceeds will be forfeited. Okay. In this circumstance, corporate debts cannot be assumed. Corporate debts cannot be assumed to be risk-free. Okay. Now, this is what I'm trying to say here is that, when the going concern of the company is shaking, when the company is unable to continue operation on a going concern basis, of course, the assets of the company will be closed down, and the assets will be disposed of. The proceeds therefrom will be used to settle the liability, will be used to pay the creditors. So say, for example, a company is owing 1 million naira. A company is owing 1 million naira, and when the company is liquidated, all the assets were disposed of at 800,000 naira. So the balance of 200,000 naira, what will happen to it? The creditor we have to lose that, we have to forfeit that, because the company, you cannot use the personal property of the owners of the business to offset the liability, because that's the essence of legal entity. All right. So the liability of the owners of the business is limited to the capital contributed. All right. So you cannot ask the owners to use their personal property to come and offset or to come and pay debt. It's not possible, because the business, the company is distinct, is different from the owners. All right. The company can be sued. The company can sue and be sued in his own name. All right. So that is what I mean to say in this particular instance. Then the second part, when there is default risk, okay, when there is default risk, again, corporate debt cannot be assumed to be risk-free. Let me put it down. When there is a default risk. So what do you mean by default risk? That is the inability of a company to pay wow. Just to write pay now is a problem. God. To pay annual fixed interest, annual fixed interest, and the principal, and the principal. So when a company defaults to pay interest, including the to make the repayments of the principal, that means the company has doesn't have the capacity to do that. So as a result, if somebody is owing you, and your debtor is saying that I don't have the means now, I will pay. First year, second year, third year, continue to grow year by year. The debt is yet to be paid. The interest is accumulating, but the person does not have the capacity to pay. The person has defaulted. So what are you going to do? Worst case, you go to court, and the court will ask, okay, when do you want to pay? Well, I will pay, but I don't have the means now. I will pay. Worst case, maybe you dispose of the assets of the company or of the person. All right. But when there's a default risk, the bottom line is that when there's a default risk, then of course, even if the person will pay at the end of the day, the person may not pay the full amount. All right. So when this happens, of course, we cannot say corporate debt is risk-free. Okay. So when there's a default risk, all right, corporate debt cannot be said to be risk-free. Cannot be said to be risk-free. Okay. So that's that. Then the B part of the number 2 requirements. Examiner is asking you, you have been given the debt beta of 0.3. So you are supposed to recompute your project specific. So I would then say where debt beta is 0.3. Oh. It's not looking good tonight. Just wasting my time. Zero 0.3. Not even writing well. Let me just manage to the end of the class. Okay. So in this case, because you have been given a debt beta of 0.3, so you need to recompute your project-specific work. You've already identified the debt beta, the proxy beta to be 1.18, so you don't need to just move on, start from step 2. But in any case, I can just come here 1. Let me just put it down. Since debt beta of 0.3 is given, you need to recalculate the project's specific cost of capital as follows. Okay. So proxy beta equal to 1.18. Step 2 says you should ungear. In this case, how do you ungear it? Because we have been given that beta to be 0.3, therefore we are going to use the extended formula. The extended formula is beta assets equal to beta equity of a gear multiplied by equity value divided by equity plus debt, 1 minus tax on one side, plus debt beta multiplied by debt value multiplied by 1 minus tax divided by equity value plus debt value, 1 minus tax. Okay, that's the formula we are going to use because you have been given debt beta to be 0.3. Therefore, the beta assets will then be equal to 1.18 multiplied by equity value of the proxy. We calculated 191,909. Okay, 909 over 191,909 plus the debt value 4,100. 1 minus tax 0.65. Okay, then plus the debt beta of 0.3 multiplied by debt value of 4,100 multiplied by 0.65 divided by 191 equity value 909 plus debt value of 4,100, 1 minus tax. Okay, so the beta assets, the one on the left, we have calculated it before to be 1.04. Then the one on the right will then be equal to 0.65 multiplied by 4,100 equal, then plus 191,909. That's 217,974. Okay, so 0.6, let me write it down somewhere. 217,974. 217,974. 974. Okay, so the numerator, which is 4,100 multiplied by 0.65 equal, sorry, error, 4,100 multiplied by 0.65 equal, divided by the answer 217,974 equal, then multiply by 0.3 equal 0.04. 0.04. Let me write that. Okay, so the beta assets will then be equal to 1.08. That's it. Beta asset is equal to 1.08. Then the next one is to count, step 3 is to regear. So you regear to incorporate the financial risk of Kilimanjaro. In this case, you repeat, because debt beta is given, examiner has told you that you should assume 0.3 for both proxy company and then Kilimanjaro. But if in the question examiner, if you are not given the debt beta of the main company, then it is assumed to be risk-free. So, but in this case, examiner says you should assume 0.3 for both proxy and Kilimanjaro. Therefore, I would then say beta assets equal to, just repeat the same formula for step 2. Equity value divided by equity plus debt, 1 minus tax. So not even looking at that well. Writing like a small child that is learning learning how to write. Everything just scatter. A plus D, 1 minus tax, plus debt beta multiplied by debt value, 1 minus tax, over equity plus debt, 1 minus tax. Okay. Therefore, beta assets will be equal to beta equity of a gear. The beta asset, we have calculated it to be 1.08. The BA is 1.08. Equal to beta equity of a gear is what we are looking for. We don't know it yet. So equity value of Kilimanjaro, 33,920 over 33,920. Let me write that. Okay. Plus the debt value of 17,400. 1 minus tax, 0.65. All right. Plus the debt beta, 0.3. Debt value is 17,400 of Kilimanjaro multiplied by 0.65, 1 minus tax, over 33,920 plus 4,100, 1 minus tax. Okay. So 1.08 equal to beta equity of a gear. Now, we need to, I would then say 0.65 multiplied by 17,400 equal, then plus 33,920 equal 45,230. So 45,230, let me write it down somewhere, 45,230. Therefore, 33,920 divided by 45,230 equal, okay, that's 0.7499, so that's 0.75. So beta equity here will be 0.75 BEG plus the other side. The other side will then be equal to 17,400 multiplied by 0.65 equal divided by 45,230 equal multiplied by 0.3 equal 0.075. Here is 0.075. So we collect like terms. We collect like terms. So here will be 0.75 BEG equal to 1.08 minus 0.075. Therefore, VEG will be equal to 1.08 minus 0.0075. This will give us 1.005. Let me confirm.
Confirm.
Is it correct?
Confirm, sir.
All right then. So divided by 0.75, 0.75. So what do we have here?
1.34.
Pardon?
It's 1.34, sir.
1.34. All right. So that's the beta equity of a gear of Kilimanjaro. So after this, we then calculate cost of equity. Step 4, we calculate capping. So capping, which is cost of equity, is the same formula. Let me just write it down, but there's no need for you to repeat formula again. The risk-free rate of return is 9%. Beta in step 3, market return minus the risk-free rate. So KE is 9% plus beta of 1.34. Market premium is 16 minus 9. Therefore, cost of equity is equal to 16 minus 9 will give us 7.
18.38.
Pardon?
18.38.
30.28.
38.
38. Okay. Here is 18.38%. Finally, I calculate WACC. The 5. WACC. Okay. So still the same formula for WACC. Equity value over equity plus debt. Cost of equity plus debt value. Equity plus debt multiplied by after tax cost of debt. So the WACC equity value is 33,920. Total value is 51,320. Cost of equity, we just calculate 18.38% plus debt value is 17,400 multiplied by after tax cost of debt of 9.5%. Multiplied by after tax 1 minus tax 51,320 total value. So from the left to be 33920 divided by 51,320 equal.
12.4. Okay, 12.14, sir.
Pardon?
12.15.
12.15%. Okay. Then the other side is still remain the same thing, 2.09%. So this will then give us 14.24. Yes, 14.24%.
4%.
Yeah, 14.24%. When you compare this with the one the one we solved in the first requirement, in number 1 requirements, so that we see that there's a margin of error. There's margin of error between the first one. I think the first one was 14.47%. All right. Let me check. And the first one we got, yes, 14.47. So there's a margin of error of about 0.23 or 0.24. So this is what examiner wants you to calculate.
Sir, are they
That's
supposed to be the same thing?
Pardon?
Are they supposed to be the same thing?
It's not supposed to be the same thing because even the way we calculated it are different. Yeah.
When you say margin of error, that is right.
Yeah, of course. Since it's not the same thing, yeah. That's what I said that. Yes. The last part of the question, examiner is asking you to discuss whether systematic risk is the only risk that Kilimanjaro shareholders should be concerned with. First thing first, you must understand the meaning of systematic risk. What is systematic risk? What is unsystematic risk? When you talk about systematic risk, it's also known as beta risk, non-specific, market imposed, unavoidable, non-diversifiable risk. It's a kind of risk that affects every company in an economy. All right, that is systematic risk. For example, during the COVID-19, you see that every companies in the entire world were affected with COVID-19. So that's an example of systematic risk. Not only that, when there's increase in inflation, all right, inflation affects everybody in the economy, except there is no individual within the economy that will not be impacted with inflation. So it's also an example of systematic risk. When there's changes in interest rates, except if you don't buy, if you buy from the market, certainly you are going to be impacted because it will also push up the price of goods and services. If a company borrows money to finance or to produce that particular product, all right. So the company we need to shift the cost to the price of the goods. All right. So that's why we are saying that, of course, changes in interest rate is also an example of a systematic risk. So, but again, on the other side, the unsystematic risk is the risk that is peculiar to a particular company or industry. All right. So for the unsystematic risk, not everybody, not all the companies in the economy will be affected. So for example, when there is regulatory change, all right, so the industry that the regulation affects is the only one that will bear it. Other industry or other company that are operating in a different industry will not be affected. All right. Again, when there is poor management team, all right, that can affect a particular company, not other company or not every company is in the economy. That is unsystematic risk, which is also known as avoidable. Okay, is avoidable. Of course, diversifiable and all of that. So now examiner is asking you to explain or to discuss whether the shareholders of Kilimanjaro PLC should only be concerned with the systematic risk. All right. Of course, to answer that, your response should be that of course, after you have explained what is systematic risk, you give the example what is unsystematic risk. You then say that the shareholders of Kilimanjaro PLC should be concerned with the total risk that affect the operation of the business. All right. So that is the answer to that one. That's the answer to that one. All right. So, yes, that's end of this. Let's have Wakuka. We have about 40 minutes more, so that should be sufficient to do Wakuka. Before that, let me see if I can restart whether the flow will be better this time around. All right. Let me stop sharing this. Okay. Thank God you reminded me. Otherwise, I would have just gone ahead and Okay, so let's talk about weighted average cost of capital of the combined activities. Weighted average cost of capital of combined activities. Which I usually call WACOCA. Okay. Now, you will recall when we started, I told you that there are three categories of WAC. We have done traditional WAC, and we have also done project-specific WAC. This is the third one, which is WACOCA. Therefore, when do you estimate WACOCA? So WACOCA is calculated when a company is engaged in several business activities. All right, so let me put it down. Cost of time. This is calculated when a company is engaged in several or different business activity. Activities almost at the same time. Therefore, instead of using different discount rates, therefore, instead of using different cost of capital or discount rates, to evaluate projects, to evaluate, this thing has not changed. To evaluate each business activity, to evaluate projects in each business unit. A cost of capital that will be suitable, for each activity we need to be estimated. Okay, so that is what is known as WACOCA. All right. So for example, a company maybe a manufacturing company, all right, may also be uh, having another business extension, say for example, real estate or into education business, all right? So if such company wants to, like Dangote, for example, Dangote cannot be using different cost of capital to evaluate project in its several business segments, all right? So instead of having different cost of capital for each segment, why don't you have a suitable cost of capital that will be consistent? I mean, a cost of capital that will be suitable to appraise all the projects instead of using one cost of capital for one project. All right. So you are supposed to estimate only one that will be suitable for all the projects. All right. So that's essence of weighted average cost of capital of the combined activities. All right. So to calculate to calculate WACOCA, there are 7 procedures you are expected to carry out. Let me quickly give you so that we can move faster. All right, procedures or steps involved in calculating WACOCA. Like I said, there are 7 procedures. The first step is to identify the beta of each activity. Okay, identify the beta of each activity. Step 2, ungear the beta if it is geared. If geared. Then step 3, calculate. Let me write it. Calculate market value of equity and debt of each activity. So this one, the same way we usually calculate market value of equity, the same way we did under traditional work, is the same way you are going to calculate the market value of equity and debt. Then step 4, you calculate. Let me rewrite it, it's not looking good. Calculate weighted average beta. Calculate weighted average asset beta, or what is called combined asset beta. Calculate combined asset beta. This pen really assets beta. That is beta asset of the combined. Then, of course, how do you do this? Okay, using the formula below. Let me push you to the next. So to get the beta asset of the combined, all right? So beta asset of the combined, or combined asset beta, is equal to the beta assets of the first activity multiplied by total market value of equity and debt of the first activity divided by total market value of equity and debt of the first and second activity on one side, plus, open a bracket, beta asset of the second activity multiplied by total market value of equity and debt of the second activity over total market value of equity and debt of the first and second activity. So this is the formula that you are going to use to calculate average beta of the combined. Okay. If the company has more than 2 activities, then you extend it with a third one. So in this formula, it is assumed there are just two business activities. All right. Then step 5, you regear. Step 5, you regear. The same formula we used to regear under project specific is the same. Then step 6, you calculate cost of equity using capital asset pricing model. All right, then step 7, you calculate WACC. Here is calculate, capping. Then step 7, you calculate Wakoka. That's it. That's it. These are the 7 procedures you are supposed to carry out. Of course, I've shortened it because the formula I'm supposed to provide under the second, for the second and the third, is something we have done previously. We just finished project specific. So the same formula you used on gear is what you are going to use. To calculate market value of equity and debt, we have demonstrated that severally. So it's the same thing. Number of shares, for example, market value of equity is number of shares multiplied by share price. Market value of debt is the nominal value multiplied by market price of the debt divided by 100 naira. So it's the same thing. The same formula you use to re-gear, all right? The same formula for capping, cost of equity, the same formula for WACC, all right? So at this point, let's have illustration. Let's have illustration to demonstrate our learnings. So I will stop sharing this and move to the working notes. Sorry, the question notes. Yes. If you have any question, please go ahead and ask. I'm all here for you. All right. Let's have estimate. Okay, I think this is it. Yes. Let's solve illustration number 16. I need somebody to help us read it. Who is helping us? Who is helping us to read it? Okay.
So, is it 16 or 19?
19.
Okay.
Thank you, Timmy. Yeah, go
Okay.
ahead.
Columbia PLC provides training and financial services. The training service accounts for 2/3 of the value of the company. The company has a total debt to total market value ratio of 30%. The average beta and debt to total market value for financial service sector are 0.9 and 25%. The average beta and debt to total market value for training service sector are 1.5 and 12%. Other information includes the equity risk premium at 3.5% and the rate of return on short-dated government stock is 4.5%. Columbia PLC can borrow at 2.5% above the risk-free rate. Corporation tax is 40% on taxable profits and assume that debt is risk-free. You are required to estimate the cost of equity capital and weighted average cost of capital for Columbia PLC.
Thank you, Timmy. Yes, that is the question. When you look at the requirements, there's nowhere examiner has mentioned that you should calculate weighted average cost of capital of the combined activities. So oftentimes, the examiner will not tell you to do that, but it is implied in the question. You should be able to deduce from the scenario painted by the examiner the kind of cost of capital that you are going to compute. So examiner is asking you to estimate cost of equity and then weighted average cost of capital. So you need to ask yourself, what kind of cost of capital do I want to calculate? Is it traditional WACC? Is it project specific WACC or WACOCA? So I will then go back to the body of the question and identify what kind of WACC am I going to calculate. When you see from the first paragraph, you are told that Columbia PLC provide training and financial services. So this company is into 2 different activities, training activities and as well as the financial activities. So this, an examiner is asking me to calculate WACC. Therefore, this represents WACOCA. This is weighted average cost of capital of the combined activities. So if that is the case, how am I going to calculate my WACC? Very simple. I have 7 procedures to calculate my WACOCA. The first step is to identify the beta of each activity. What is the beta of training? What is beta of financial service? Step 2, I will ungear the beta if it is geared. Step 3, I will regear. Then step 3, I will calculate market value of equity and debt. Then step 4, I will calculate weighted average asset beta. Step 5, I will regate. Step 6, I will calculate cost of equity. Then step 7, I will calculate WACOCA. It's as simple as that. No matter how big is the question, if if examiner likes, it should give you 10 pages of a question. It's the same procedure. Just go ahead, follow those 7 procedures to calculate your WACOCA. So without wasting more time, I will stop sharing this and move to the working note. Or am I sharing the working notes already? I don't think so. Let me check which one I'm sharing.
It is the question you are sharing, sir.
Oh, okay. Let me stop sharing then so that we can move to the work. Within the next 20 minutes, we are done with this. Okay. So solution to illustration. This is what Yoruba call adìyẹ kọ̀wé òyìnbó kàtì. Solution.
Interpretation, please.
Pardon?
Interpretation.
Please, you can help me interpret. You know, I didn't go to grammar school, so. All right, solution to illustration 19. I think it's still on page 36 or 35. Let me confirm.
33,
Yeah,
34.
33. Yeah. So here is 33. Page 33. All right. So the name of this company is Columbia PLC. So examiner did not ask us to calculate WACOCA, but we have identified from the question that this company is into 2 different activities, training and then financial services, which means that we are supposed to calculate WACOCA. So to get WACOCA, we need 7 procedures. So I would then say step 1, let me put it in perspective for your understanding. Since Columbia PLC is into training and financial services, WACOCA, we need to be estimated, or WACOCA is the appropriate. WACOCA is the appropriate cost of capital to be calculated. Remember, if a company is diversifying, that's only when you calculate project specific. So the key thing to look out for under WACOCA is if the company is engaged in several activities. All right. Let me write this. Service. We need to be calculated. This is shown as follows. Okay. So step 1, we identify the beta of each activity. Again, no need for you to say identify, just go ahead. So I'll just say beta of each, beta of training, denoted as T, and financial, F, services. Okay, so for training, I will then go back to the question, what's the beta of training? According to the question, in the second paragraph, you are told that the average beta, that's for financial. In the third paragraph, you are told that the average beta and debt to total market value. Debt to total market value means gearing ratio, all right? So the beta of training is 1.5. The gearing ratio of training is 12%. Then in the second paragraph, the beta of financial service is 0.9. The gearing ratio, the debt equity proportion of financial service is 25%. Therefore, 1.5 and then 0.9. For training, beta is 1.5. For financial service, beta is 0.9. I need to ask myself in step 2, this beta of 1.5 and 0.9, are they geared or ungeared? Of course, if there is debt associated with each of the activities, it means that these betas are geared. So again, the betas are geared because examiner has given you gearing ratio. All right, you have been given total debt to total market value to be 12% as well as a 25% training and financial services. So which means that these betas are geared. So we need to ungear it. Okay. Let me write this one on gear. Let me help you. Additional notes. Since debts to total market value, debt to total market value of each activity of training, let me put it this way, of training and financial services are given. It means the beta in the beta above the betas above are geared. Okay, so since they are geared, what do? You ungear it. Then to ungear it, examiner has told us that their beta is assumed to be risk-free. Okay, in that case, beta asset will then be calculated as beta equity of a gear multiplied by equity value divided by equity value plus debt value 1 minus tax. All right, so I will do for training. Okay, so beta, let me write it, beta asset of training, BAT. Beta asset of training will then be calculated as beta equity of a gear of 1.5 divided by, multiplied by equity value. I need equity value of training. When you go back to the question, you have been given debt equity proportion of training to be 12%. Debt to total market value for training is 12%. So if debt is 12%, equity is 88%. So here will be 88 divided by 88 plus debt, which is 12. The tax rate given in the equation is how much? What's the tax rate? 40%. Tax is 40%. 1 minus 40% will give us 60%. Let me rewrite this 88. It's not clear. Okay. So what do we have here for training services. Start from the denominator, 0.6 multiplied by 12 equal to 7.2 plus 88. 95.2. So 88 divided by 95.2 equal, multiply by 1.5 equal, that's 1.39. 1.39. The beta asset of training service is 1.39. I will do for financial services.
Sir, no, it's 0.83.
You're on your own.
No, sir. 1.39.
It's 1.39. It's not 0.83. Do it again. All right. It's 1.39. Thank you. So for financial service, beta asset of financial service, so for financial service, we identify beta to be 0.9. Therefore, the equity value of financial service will be 75. Since we are told in the second paragraph that the debt to total market value of financial service is 25%. So if debt is 25%, equity will be 75. So here will be 75 divided by 75 plus debt 25. 1 minus tax, that's 0.6. Again, we get our final answer. Start from the denominator, 0.6 multiplied by 25 equal plus 75 equal, that's 90. So 75 divided by 90 equal, multiplied by 0.9 equal 0.75. This is 0.75. So the beta asset of financial service is 0.75. Then step 3 says we should calculate market value of equity and debt of each activity. Step 3, market value of equity and debt of trading and financial. All right. So, like I said, the same way we normally calculate market value of equity and debt under traditional work is the same way you are going to calculate this. All right. So for training, examiner has already told you in the question, when you go to the first paragraph, you are told that the training service accounts for 2/3 of the total value of the company. The training service accounts for 2/3 of the value of the company. So if training accounts for 2/3, it means that financial service will account for 1/3. All right. So here is 2 divided by 3. There is no need for us to calculate market value again because examiner has told you that the training accounts for 2/3. All right. So here is 2/3. Then financial service will be 1/3. 1/3. That's the market value. Then step 4. Step 4 says you should calculate average asset beta of the combined or combined asset beta. So here is combined asset beta, BAC. All right. So combined asset beta will be calculated as beta assets of training multiplied by total market value of equity and debt of training divided by total market value of equity and debts. Okay, let me write this V. TMV of training and then financial service. on one side plus, open a bracket, beta asset of financial service multiplied by total market value of equity and debt of financial divided by total market value of equity and debt of training and financial services. Okay, so you can see in this one, I'm not using BA of 1 and BA of 2 because I already know the name of the activity. That's what I'm using T and F instead of 1 and 2. All right. So beta asset of the combined will then be equal to beta asset of training. In step 2, we got for training is 1.39. So I will say 1.39 multiplied by total market value of equity and debt of training over total market value of equity and debt of training and financial. Here is 2/3 plus beta asset of financial service. We got 0.75. 0.75 multiplied by market value of equity and debt of financial service, which is 1/3. Okay, so then BAC, beta asset of the combined from the left. From the left, it will give us 1.39 multiplied by 2. Sorry, I did 1.9. 1.39 multiplied by 2 equal divided by 3 equal, that's 0.93. Here is 0.93. Let me write it. This really must delay my time today. So 0.75 divided by 3.
0.25.
0.25. Here is 0.25. So plus 0.93.
1.18.
1.18 is the beta asset of the combined. I will then move to step 5. Step 5 says it should regear to incorporate the financial risk of the company. So now from step 1 to step 4, your focus is on the information of each of the activities. From step 5 to step 7, you need the information of the company. All right, I repeat, from step 1 to step 4, your focus is on the information on each activity. While from step 5 to step 7, you need the information of the main main company. So step 5, you want to regear to incorporate the financial risk of Colombia. So in this case, the formula you are going to use to regear will depend on whether debt beta is given or debt beta is assumed to be risk-free. So according to the question, we are told that debt beta is risk-free. Therefore, beta equity of a gear will then be calculated as beta asset of the combined, all right, multiplied by 1 plus 1 minus tax. Okay, let me write this. 1 minus tax, debt equity proportion of Colombia, the debt equity proportion of the main company. So beta equity of a gear will be equal to 1.18 multiplied by 1 plus tax rate according to the question is 40%. So we are supposed to account for 60%. Then multiply by the debt equity proportion of Colombia. According to the question, from the first paragraph, we are told that the second statement in the first paragraph, we are told that the company has a total debt to total market value ratio of 30%. It means that the gearing ratio of Colombia is 30%, which means that debt is 30%, equity is 70%. Okay? So I will then come here, Debt, D is the debt. So debt is 30 divided by equity of 70. All right. Therefore, beta equity of a gear will then be equal to 30 over 70. 30 divided by 70 equal multiplied by 0.6 equal plus 1 equal multiplied by 1.18 equal to 1.48. So beta equity of a gear is 1.48. Then step 6, we calculate cost of equity. Cost of equity using capping. Capital asset pricing model, KE. Therefore, KE equal to risk-free rate of return plus beta into market return minus risk-free rate of return. All right. So, cost of equity, I'll go back to the question. What's the risk-free rate of return? According to
4.5.
the, yes, 4.5. We are told that the rate of return on short-dated government stock is 4.5. I've told you already, the risk-free rate of return is the rate of return associated with government security. So short-dated government stock is 4.5%. Okay, so here will be 4.5 plus the beta we calculated in step 5, which is 1.48 multiplied by market return minus risk-free rate of return.
3.5.
So according to the question, examiner has given to you equity risk premium. So you are not given market return, but you are given equity risk premium. You recall when I was giving the note last week, I mentioned to you that market return minus risk-free rate of return is called market risk premium. This is called market risk premium. All right, so you have been given the market risk premium, risk premium to be 3.5. All right, market risk premium to be 3.5. So here you just put 3.5. That's it. So cost of equity will then be equal to 3.5 multiplied by 1.48 equal then plus 3.5, sorry, plus 4.5. That's 9.68. Cost of equity is 9.68%. Then finally, step 7, you calculate WACOCA. Denoted as KW. So calculate WACOCA. WAC is calculated as equity value over equity plus debt multiplied by cost of equity plus debt value over equity plus debt multiplied by cost of debt 1 minus tax. Okay, so WAC equal to equity value is 70% because examiner has told you that debt to total market value of Colombia is 30%. All right, the company has a total debt to total market value ratio of 30%. So the gearing ratio is 30%. So if debt is 30%, equity is 70%. So here is 70 divided by 100 multiplied by cost of equity of 9.68 we calculated in step 6. plus debt value is 30%. After-tax cost of debt. The after-tax cost of debt is, we go back to the question. You are told that Columbia PLC can borrow at 2.5% above the risk-free rate. The risk-free rate of return is 4.5. 2.5% above 4.5 is 7%. Cost of debt is 7%. So here will be 7%. After tax, tax is 40%. So you are supposed to account for 60%. Total value is 100. All right. So from the left, that will be 0.7 multiplied by 9.68.
6.776.
That's 6.78, 6.78% plus from the right. That would be 0.3 multiplied by 7 multiplied by 0.6.
1.26.
1.26%. When you add the two together, WACC will be 8.04, right? Am I correct? I think that's 8.04.
8.04, so you are correct.
All right. So the WACC is approximately 8%. Yes, note. Let me put it down so that you don't forget. Note, cost of debt, according to the question, we are told that is 2.5%. 2.5% above risk-free rates of 4.5%, which means KD is equal to 2.5% plus 4.5%. So KD is equal to 7%. So that's how we got that 7%. I'm not sure. The first one we solved on project specific, we did do the same thing like that. Let me check. If not, I'll just, okay, I didn't state it. So that's for your own understanding, so that you don't forget, so that you don't struggle on how we got it. Let me put it here. The cost of debt of 9.5. Note, KD equal to 0.5% above treasury rates. Treasury rates of 9%. Therefore, KD equal to 0.5% plus 0.9, plus 9%. So KD equal to 9.5. All right, so that's clearer. Yes, Ufoma, talk to me.
Oh, so I was thinking that the risk-free rate is inside the risk premium now.
It's inside the risk premium. No, that's not what I explained to you last week. Ufoma,
She
the
was
thing
thinking.
is, so this is it. Let me explain again. Cost of equity is equal to the risk-free rate of return plus beta multiplied by market return, what's wrong? Market return minus risk-free rate of return. So this is the formula for calculating cost of equity using capital asset pricing model. And I said that RF is equal to risk-free rate of return. Okay. Then B is beta value. Let me rewrite it. Then RM is equal to market return. Market return. And I told you last week that the difference between market return and the risk-free rate of return is called market risk premium. Market risk premium. So when you are given market risk premium, there is no need for you to minus risk-free rate of return again, because the difference between RM and RF is already market risk premium. So if you are given market risk premium, just put the number there. Don't minus with risk-free rate of return again. Ufoma, do you get it now?
So you know what I'm saying? So because they gave us the return, which is 4.5.
What is that return given to you? What do you call the return given to you? Oh yeah, now Ufoma, you said they gave us return of 4.5. What did the examiner call that return of 4.5? Ufoma, talk to me.
They say it's on short dated government stock.
So what did I call the 4.5?
You say it's risk free.
So what do you want us to do? You want us to use that one as
I
so
was thinking you will subtract the 4.5 minus 3.5 to get your risk free rate.
what is 4
Then
point
from
that 3.5? What did the examiner call the 3.5?
it's premium, risk premium.
So why did now I just explained to you that the difference between market return and the risk-free rate of return is market risk premium. Why do you want to minus 4.5 from 3.5 again, even after my explanation? So once you are given risk premium, you don't need to minus risk-free rate of return. Just put the risk premium inside the bracket. That's all. You only minus risk-free rate of return if you are given market return. In this question, you are not given market return. Instead of market return, examiner is giving you risk premium. So the risk premium is the difference between market return and the risk-free rate of return. So no need to minus anything again. Just put the number there. Is it clear now?
Yes, sir. Thank
All
you.
right. You're welcome. So, yes, that's end of the question. And then let me know if you have any question for me so that we can close the class. I'm really sorry for tonight's class. I struggle all throughout from beginning to the end using the pen with the screen. So it's malfunction tonight. So hopefully before our next class, everything will be sorted out. All right. So let me know if you have any question for me so that we can close for today. Okay.
Yes, sir. So I don't know if these are the questions because this Wakoka, at first it looks difficult, but now it's now looking very simple. And your people will not even test this kind of question.
No. It's anything that has to do. Cost of capital generally is straightforward and is simple. The only thing is just that you must know how to interpret questions. At times, examiner can throw you off balance. In most cases, examiner will include it in addition to MPV, for example. So this may come as number A requirement. In fact, in recent times, what is common is project specific. All right. So number A requirement, examiner can say so you should calculate appropriate cost of capital. Then number B, evaluate. Number C, state your assumptions. All right. Number 4, maybe advise whether the project should be undertaken or not. So this is one of the ways examiner can test you. But generally, anything cost of capital is always very simple and straightforward. But the only challenge that students usually have is ability to interpret the question. All right, ability to interpret the question. So no matter how big or how voluminous is the question, is the same principle, is the same concept. All right. So just go in there, understand the requirements. Once you understand the requirement and you know what you want to calculate for, just take it step by step and you are good. All right. It's not difficult at all. Okay, so as we proceed, when we get to capital budgeting, we are still going to solve several questions on project specific. I think there's one under Wakoka as well. So that are combined with NPV calculation. So you are going to see more of that as we proceed. All right. So this is going to be this is lecture day 6 on cost of capital, and this is the final class on this. So when next we meet by the grace of God, we are going to be starting capital budgeting. So that will also take us for the next 4 periods. Okay, minimum of 4 periods. So let's get ready for that as well. And then I want to encourage you. So you already have this material. Go ahead and begin to read. Go and read about capital budgeting. Like I said, it's the next topic that we are going to have. Capital budgeting is the same thing as a capital investment decision. So go ahead and read about it. All right. And then if you have the golden book already, if you have the SFM golden book, you can just go ahead and be practicing the question and answers that you have there. Read it thoroughly, then practice the question and answer so that in case you have any gray areas, you can ask me in our next class. So that will be that for today, and I will see you next time by the grace of God. Good night, everyone.
Thank you, sir. Good night.
Good night,
You're
sir.
welcome.
Thank you.
You're welcome.
Thank you, sir.
You're welcome, Minister of Finance. Don't forget my contract. Yes, X. Okay. Let me see.